Well, welcome to the next video in the Nephew Elite series. I know we're calling him Elite and he's not quite there yet, but that's the intention, so it's a little tongue-in-cheek, but he will be there. So this is where I'm teaching my nephew how to trade. By next week, he's going to be trading the market, so we've already set a date. He's going to be trading the market regardless of where he's at. We'll see how that goes. In this video, you're going to learn, I'm going to teach him the difference between an EMA, an exponential moving average, and a simple moving average. So you ready to get started?
Yes, sir.
All right, sweet. So we see on the chart already. So I've already added this to the chart. I've added, and how you could do this, you just add exponential. So we already learned about, you can see that moving average exponential. Mm-hmm. We already learned about simple moving averages. So the simple moving average here is blue. And the way to explain a simple moving average in a week recap is it literally is an average. It gives equal weight to every single one of the closes, the last 20 closes. And then it divides it by 20. And then that line that you see here, that is the moving average of the last 20 bars. Okay. The price. Oh, so now when you add an exponential moving average, what that does is it gives more weight, more precedence to recent price actions. Meaning that it gives more weight to the recent candles. So one of the ways that it's explained is that an EMA will be closer and will respond faster than an SMA, because an SMA doesn't factor in, it equals everything, but the EMA, it's looking at the recent price, so it's going to be closer to what the price is, usually. Does that make sense?
Yeah.
So that's kind of the one way to look at it. The reason why is that generally for longer time frames, so you've already learned about the Rexdog average. And many people discount the Rexdog average because what it is, it's 6 simple moving averages averaged. And people discount simple things in trading because, oh, it can't be that simple. It can't just be 6 moving averages. Well, we can pull up chart, and we're going to go through a video here where I'm going to reveal to you, I'm going to share with you the full system, like at a high level concept. And then we're going to go through, and this will be a members video. We're going to go through and we're just going to go random ticker by random ticker. And I'm going to show how reliable the indicators and the rules that we use in the Rexdog system. And you're going to look at the RDA, the Rexdog average. And you're going to say, well, it's just 6 simple moving averages. That's simple. Yeah, well, you didn't see the amount of effort and time that it went in for me to figuring out exactly what moving averages I should use. And you didn't see that I went all the way from 500 all the way down to like 2 to figure out what's the right mix. And then I told you don't ask why. Yeah. It just kind of works. Well, I've often tried to figure out why the RDA works so well. I think I figured out one of the reasons. One of the reasons is that it includes all of the simple moving averages that is used in a lot of trading systems. So what you get is you get a bleed over of, some people use the 200 simple moving average. Okay. And we use it in our system. Some people use the 50. Some people use the 48. Some people use the 48 EMA, the exponential. Some people use the 20 SMA. Remember Bollinger Bands? Yeah. That's using the 20 SMA. Okay. But you could put an EMA in there, and then it would react quicker to recent price action. Okay. That makes sense? Yes. So I guess the one thing to notice is the EMA is red, and you'll see that it's closer to what the price currently is, or when it moves, it's closer to where that price is moving. I mean, do you see that in the chart, or is that crazy? That's one thing I'd be interested to see. This chart here with the 1 hour Bitcoin, when you look at just the red line, does it look like the red line's closer to where price is than the blue line? I mean, sometimes it's different, right?
Yeah, and for some of it, they're almost like kind of in the same spot for the lower. But I see when it jumps, the red is falling higher. Yeah. More to like the blue's like going wider out before it's slowly going up.
Yeah. So the way it's talked about is that the SMA is more smooth. Mm-hmm. So, and then the EMA will be more jagged because it's following the recent price action. Okay. Minor point, but actually understanding this is actually critical, because when you start maybe looking at indicators, or you start maybe creating indicators, because I just know, I mean, this is aside, we'll go down this rabbit hole. I know in a couple weeks you're going to come to me and you're going to say, hey, that indicator you use is really cool, but what about this indicator? Because I just know your mind, or at least so far, right?
Yeah.
I just know you're going to come up with other ideas because you already are starting to. I already see your wheels turning.
Mm-hmm.
So I'm teaching you a lot of these basic things because so you don't have to maybe necessarily learn the foundation, but at least you have a good foundation to then go out
on.
Yeah. And then you'll be like I am, obsessive about going out there and learning everything you can.
Branch out, yeah.
Yeah. So I'm kind of doing a dual thing here with some of this training with you, just so you know. So, in a recap, what's the difference between a simple moving average, an MA, and an EMA, exponential moving average?
Okay. So like an SMA, like you said, was more smooth. I guess that's a really good way to explain it, as well as it's following at the last 20 bars of average.
It's a simple average. So
yeah,
it's literally just taking 20 bars and dividing it by 20.
Mm-hmm. And the EMA is giving more presence or weight to the price of those most recent price. Yeah. As well as the EMA is following more closely to the most recent price.
Yeah.
Okay.
That would be a good way to look at it. And you can look up the calculations on Google or whatever as far as like how is the EMA calculated. There's a calculation. It makes sense when you dive into it. So.
Okay, I'll have to look at that later then if you could send me that.
Yeah, for sure. So that's the difference. But understanding that difference is so for instance, I'll share what we use in the Rexdog system is we use a mix. One of our indicators mixes these two together, or you can mix these two together, the SMA and the EMA. And then based on where the SMA is in regards to the EMA, it gives us higher confidence to take a particular trade. Or it tells us whether or not the market, whether or not what we see on the chart is real, or we should believe as much based on the color of that line. Okay. So that's why I really wanted you to understand just a brief difference, because some of our indicators we do mix and match.
Mm-hmm. So could you technically have an SMA, an EMA, and then one that is combined with both of them?
Yeah. Okay. So we could create an indicator right now, and what we could do is we could say, and it would take us less than 2 minutes, where we would say basically let's take the MA of 20 and let's take the EMA and then let's combine them into one line, and then it would give us one line.
Okay.
And then that would be basically the average between those two averages.
Okay.
So that's a strategy that some people use as well, and there is edge there in doing it. Well, we'll get into that. There's some edge in doing it in certain moving average prices. I'm actually working on something that's new to the system that does something similar to what you're talking about, only it's doing some different calculations that is almost as reliable as the RDA, only it'll be used for stop losses. So one of the things that the biggest thing in trading is managing your risk.
Yeah.
So but automating where your stop loss should be is a very hard thing, because it's so specific on what I call the story of the chart. Okay. Meaning at that point in time where that chart is, where your stop loss should be is really hard to calculate, because it kind of takes more of a thinking mind to really understand because you don't want your stop to be hit, but you want it far enough away, but you also want to protect your capital.
All right.
So you're going to learn, we'll probably do an indicator. No, we will do an indicator where I'll teach you the ATR indicator, which is the average true range.
Okay.
So that you understand that. Some people use an average true range indicator for their stop loss, which basically what an average true range does is it will tell you the range of the last 21 bars, like the total range, like how much they moved. And then what you do is then you say, okay, well, the average range is like $400 of the last 21 bars.
Okay.
My stop loss should be at least $400 from where I'm at.
Okay.
That's one simple way to use it.
So their high and lows where they hit at?
No. I think let's not dive into that rabbit hole, but
okay.
Because once you see the ATR in action, you'll completely understand what it's doing.
All right.
So I'm just sharing with you the general concept of there is the stop losses are one of the biggest challenges. I know we kind of went off on a tangent from this video, but that's fine. Because people want an indicator that tells them exactly where to put their stop. The challenge with that is that I have many indicators. I probably have 10 that I've created. None of them are at the level that I want to release them, because they don't provide enough of an edge that it doesn't take in enough of the factors that you need to factor in for your stop loss. And it's really not that it's difficult once you understand the rules. It's difficult to put into a algorithm. It's difficult to say that I'm taking this trade, it's a scalp trade, I'm only going to be in it for 10 minutes, so my stop loss should be close.
Okay.
Compared to like if I'm going to do a trade where I'm going to last a couple days, I want my stop loss to be wider, but then like how can I use the same indicator to look at the data and give me the same type of data that I would want to properly place my stop loss? I know I'm getting into the weeds. So who knows if this is still in the video, then we both said, yeah, it's good enough, even though we went down a rabbit hole. So, but this is good because this is actually some of the conversations that you're going to have with trading is that you're going to go down these rabbit holes because you're going to get to concepts. So what I'll end with, because you recapped it good, is a lot of the concepts you're going to learn are simple. And I know you're going to say to me, because I've had people that I've trained and everybody else, is that it's so simple, like it makes so much sense. How come people aren't just killing it? How come they're just not, good traders? Because while the concepts are simple and the rules are simple, what happens in real time is that your emotions get involved, your fear gets involved, and that takes over. Because looking at a historical chart, you're seeing things that look obvious actually today is a good example. Today was a very frustrating day for me. I live streamed today, and I was up about I went between about $900 and like $2,000 for like an hour and a half because I was so frustrated with the price action. It was just so annoying. It was like watching paint dry. So when I'm live streaming, like I can't do other things, so I'm utterly bored. So I was and I felt waterlogged, so I didn't want to take trades. But when I saw the one or two trades that I was waiting for, I jumped on it, and I ended the live stream with about 4,700.
Okay.
Ended today about 12 grand.
Nice.
So I traded a little bit more, but why I'm sharing that is because, so I was following when I was doing that where I was bouncing between $900 and $1,800 or $2,000, I was trading one lots and I was following our system. I was doing some fade trades, but here's the thing that's utter frustrating. We could pull up the chart from today when I was trading, and if you understood the system, you would say, why were you doing any other trades but short? But in real time, I wasn't always shorting the market. But we could look back at the chart with the understanding and the rules of the system and say there was no time during that hour and a half you should have been going long unless you were doing a quick fade. So, and I even said it in the live stream. I said, I'm going to look back at this day. I'm going to think I'm an idiot because the chart's telling me to go short. And like an idiot, I fall into one of the only bad habits that I still have is fading too much. I fade the market too much. I have to always be in a trade. So if I miss the momentum trade with the market, then I fade it, but then I'm over trading. So then eventually what happens, like today, the trade that I'm waiting for hits, and then I go heavy. I didn't go heavy, super heavy today, but then I go heavy and then I make the trade I'm looking for. But we could go back to the chart today and I would, and in hindsight, I could say, what the heck was I doing in real time? So that's what's so frustrating about trading is that you can go back in historical charts and with indicators and everything else, and you can say, oh, when it does this, it does this, it does this, I do this.
Okay.
Except in real time, that's a lot harder decision to make in real time. I mean, you get it from all the training you had and everything else. Like when there's real action happen, that's completely different from training. You try to train the way you fight, but you can never quite get there, right? You can never quite
have
replicate
that full experience.
Yeah, so that's with training. And someone mentioned too early on, well, you should get him into market quicker so that he can deal with his mental issues. Well, you don't even know what you're doing yet, so I don't even like any mental issues you have now. There's no reason to just throw you into a chart. That'd be literally me getting into a 747, we're just flying over the ocean, I throw you into the ocean.
Yeah.
Like, I'll see you. Hawaii's
So
that
bad.
way.
Yeah.
So I'll see you in Hawaii in about a week. So that's literally what that would be.
Yeah.
So, and I'm not that mean to you. So,
Yeah.
so I know I went off on a little tangent, but I think it will be helpful for people because even I mean, not like I'm some like master, even at my level, I should say, where I'm positive P&Ls. I don't have losing days. It's just a matter of how much I win when I trade. I'm not always trading at size because I feel how I feel and my health and everything. But even at my level, I still make dumb, stupid mental mistakes where I argue with what I consider the best trading system on the planet, the one I created. So it's just so frustrating. Like, you know what I'm saying?
Yeah.
So what I learned about teaching our other nephew, or my nephew, is that he took everything I said as gospel. So when he sat down to trade the market, he didn't question anything.
Yeah.
He just, and I told him, these are the best trades that you do, momentum trades.
Mm-hmm.
And he did it. He didn't question it. He didn't double think it, because he took everything I said as gospel.
Yeah.
Because I think I'm smarter than the market. I disregard my own gospel. Does that make sense?
Yeah.
So I know I went off on a tangent, and hopefully people find this valuable. Anything you want to add before we call it quits on this video?
No, just a lot of information.
Yeah.
And glad I was here to able to listen to it.
All right, sweet.
Yacht.